Before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Welcome back to the Loonie Hour, episode 21. As always, joined by the three amigos here. We've got Rich Diaz at Acorn Macro Consulting, the Tom Brady of macro. And we've got everyone's favorite boomer, Keith Dicker, in the sexy black tarp today. Welcome back to the show, gentlemen. A very important episode. I suspect we'll have a lot of people hitting the play button on this one. The first rate hike from the Bank of Canada since 2018. Highly anticipated. I think there's a couple Twinkie wagers on it. So we're going to get to some full commentary on the Bank of Canada's interest rate hike, as well as some commentary. We're filming this show a little bit later today because I begrudgingly made these guys. I told them that I had to get through the whole presser of listening to Tiff Macklem, so that took some time. That guy is extremely boring, but we'll get into that again in a little bit here. And then we want to touch on some of this commodity boom that we've got going on. Obviously, that's going to play into some of the inflation moving forward, and then sort of an update on Russia, Ukraine here. So that's kind of the docket for today's show. But yeah, I guess first and foremost, let's lead it off with your first rate hike since 2018. So 25 basis points. I think it was baked in the cake. I had people even though texting me the day before being like, it's not going to happen, Russia, Ukraine. Like, the guy had to move. There's political pressure, I think more importantly on central bankers, that they have to do something and they have to at least act and pretend to be tough on inflation. And so there really wasn't a choice, which we'll get into moving forward, of how many more rate hikes they're going to get into. And then we had Tiff Macklem's commentary following up today. So they hiked rates yesterday with no real announcement. And they followed up today with a little bit more context on that announcement, which we'll get into. But I guess your initial reaction, Keith.
To what?
He's sleeping. Sorry, guys. He just woke up from his nap.
I love these events. And I forget what word you used to describe. What did you describe Tiff as a couple minutes ago? What was
I said he's boring as hell. I said I miss Pelosi and his metaphors that he had.
Yeah. So I like all these guys for what they are. It is what it is with these guys. So a couple things about today's presser. It wasn't really a presser, by the way. And it is very different. If you're listening to it from what I say, you're going to say, oh yeah, that's right. It was different. So for the Bank of Canada normal meetings they have a presser afterwards, which is hosted by the Bank of Canada. But the people invited to ask questions at the Q&A is the mainstream media guys, so Bloomberg, CTV, CBC, and guys like that. From my perspective, those there are a lot of beach ball type questions. They're not really representative of what investors and managers or the everyday person is thinking about. You always watch those pressers, I do anyway, to see what he says, right? Because they don't really, and if you watch any of the Parliament Q&A sessions or anything, the politicians, they never answer the question they're asked. They just say what they want to say, right? So it's kind of funny. So that's what you watch from the normal pressers with the Bank of Canada. Today's presentation was hosted by the CFA Society in Toronto. And the Q&A was really good. There were some thoughtful questions in there. A lot of them were sort of overlap with what you'd get from a regular Bank of Canada presser, but these were really good. So if you have a chance, go back and watch the recording on it. It'll be on the Bank of Canada website. But overall, the theme, and again, if you listen to what the Bank of Canada is saying, when they explain what's causing inflation in the Canadian economy, they're touching on everything. They're very accurate with that, and that's great. You can't poke any holes in it. The one thing they do leave out, though, they never say that they caused the housing inflation bubble that's taking place. They made no contribution to that at all. And that's just wrong. You have to own up and say, you know what, we may have contributed to it, but their hands off that. But they talk about supply chain disruptions, people working from home. Today, he had a good conversation that, the goods prices. So people were buying computers, gyms for their homes and stuff because of the lockdowns, and they were spending less on services, going out to eat and things like that. And all that is correct. However, they're also very adamant that the response to control inflation is going to be them raising rates. So on the one hand, he said the reason inflation has gone skyrocketing is because of the shutdowns and people can't, commodity prices have gone up and all that stuff. And of course, Russia was the first thing he mentioned, what's causing inflation, which only started 2 weeks ago. So that's a bit hard to reconcile. But again, the takeaway from it is one thing for us to joke and say, they don't know what they're doing and all that stuff. They do. But the takeaway message is they're going to raise rates and they are going to continue to do it until they're not able to anymore. That was very strong today, the message was. And he even said, hey, they wouldn't be afraid of raising rates by 50 basis points during a meeting. So I thought today's meeting was actually a lot more hawkish than what I was expecting. And but overall, I do encourage people to watch it. It was pretty good. Yeah,
before we jump to Rich's commentary here, I just... on the housing front, you talk about central bankers never taking the blame. It's funny because they've actually come out, a lot of them, not just the Canadian central bank, but the Aussie central bank and the New Zealand central bank, and their defense is basically that they view housing inflation as a fiscal problem. They view it as a fiscal responsibility on the federal government level. So that's kind of the craziness of it, but. Rich, I don't know what your thoughts are here.
Well, just to address what you just said, I think they're sort of right, aren't they? Fiscal is in like it's a government legislative problem, like Canada allowing too many people into this country, or trickiness with red tape and zoning and stuff like that. I mean, to some degree, I would argue that the Australians probably have it right. To say that the central bankers have nothing to do it is absurd. I don't know if I was taking Tiff Macklin, I wouldn't want to tell everybody I was doing a shit job in a press release or in a presentation. So I can understand him sort of skirting that answer. As far as to be honest with you boys, I did not watch the presentation. I knew the two of you guys would do it. I've watched so many of these, whether it was Mario Draghi or Ben Bernanke or Jerome Powell. My point is, I think you're right. I think they had no choice. I think they had to do it. I think what's interesting from Keith's comment is, I think something that we should, I think it's going to flow into sort of my broader macro picture when we get into it, which is to say, although the invasion of Ukraine is sort of top of the mind and top of the headlines, it's kind of screwed up to, we're going to get into this later. It's kind of screwed up to admit it. It just doesn't have that. I don't think it doesn't really have that much impact on the global economy in the medium term. And I think that's what these guys are sort of trying to address, which with, I think, the more hawkish comments. I mean, that's sort of my view. I don't have anything more to add.
I was just going to say that Tiff Macklin is just, man, he is so boring. I think he's like the guy when all like the boys get together for a beer and he's the guy that orders the soda water. I don't trust the guy that orders the soda water.
Yeah, no. But he's supposed to be boring though, isn't he?
I don't know, man, but I think Pelosi would slam beers.
Well,
that guy looked like a bro.
What is it? Abraham Lincoln, a man with no vice has little virtue.
Pelosi is like the guy that comes to like your beer league hockey game with a 48 pack and crushes 12 of them after the game in the parking lot. But yeah, I don't know. In all seriousness, yeah, I think watching the presser, basically the takeaway that I got was that he was quite hawkish. More hawkish than I was anticipating. I thought that he might use more of the Russia-Ukraine as more air cover to not raise. But I mean, the one thing they did say was, they'll continue to kind of monitor inflation. They'll monitor its impact on the housing market. I think the one thing that he said, which I tend to disagree with, which was that our economy can withstand higher interest rates. And I think, we can withstand 50 to 75 basis points, maybe 100 basis points, but I still think that I think everybody's wildly over optimistic in terms of basically, I think we're a housing economy, and I don't think our housing market can withstand mortgage rates north of 3.5%. So that's kind of the key number that I'm looking at. Now, keep in mind, when I say this to people, I'm assuming that with rates at 3.5%, inflation is within its range today. I mean, if inflation's at 8 and mortgage rates are at 3, then I mean it's probably still fairly bullish for the housing market.
Party on.
Yeah, I don't know. I mean, what else can I say on? I mean, I'm kind of curious your guys' thoughts. Do you guys have any updated views on the projection for end of this year? I mean, I know we've all been somewhat on the same page of 2, 3, maybe 4 rate hikes this year. Do we get next announcements in April, right, Keith? Is that do you think we're getting another 25 basis points in April, or does he pause and wait for the next meeting?
Yeah. So first of all, you made first. You should also explain. Maybe some listeners are not familiar when we say the word hawkish or dovish. Maybe explain what that is. But before you do that, you actually, when I was listening to you, I'm thinking, oh yeah, like you just hit on the most important message that came out of the Bank of Canada's meeting today. Was that he said, hey, the Canadian economy has enough slack; it can absorb higher rates, and I don't think it can. That's my own view. So there is a bit of a collision coming up here, and we'll sort of weave into that as we go along here, because there's a lot of forces coming into play. But again, that is one of the key, because it gives us the message that they're going to raise rates. They're going to keep raising rates now until they're not able to anymore. And usually the moment they stop, it's always a little bit too late. It's after the accident has started.
Well, yeah, no, I was just making the joke on Twitter the other day because I was like, this is pre-Bank of Canada rate hike. And I was like, these guys are literally starting their rate hiking cycle as the housing market is actually turning. I can say that with pretty full confidence right now as someone that works on the ground day to day and chatting with everybody in the industry. Like, things are changing.
When you say turning, do you mean the month-on-month rate of change is negative? Do you mean it's just that second derivative has slowed, or do you mean the year-on-year prices are now, the year-on-year price change is now negative? Is that what you mean? No.
Yeah, that's a good question. So everyone's like, well, is that going to show up in the data? Like, this isn't going to show up in the data for a couple months, but like, I think what you're starting to see is like housing activity is beginning to slow. It's coming off of like all-time like record hot frothiness, fever pitch. And so what I mean by that is like, okay, you can see it. This is happening in Vancouver. This is happening in Toronto. Where basically, houses that were typically getting like 10 offers on a house, like you're seeing a lot of houses now only get 1 offer, 2 offers. Sometimes on offer date, you're not getting any offers. You're like, well, that's strange. Like, had that house been listed for sale 3 weeks ago, they would have gotten 8 offers and now they're getting 0. So like, you're starting to see that shift. I would say that's kind of what I'm saying. So it's like, are prices falling? No. I mean, is it still extremely hot market? Yes, but it's starting to change and we're just beginning our rate hiking cycle. So I find it like the timing is always ironic because I mean, I think there's a strong argument to be made that it takes some time for monetary policy to filter through into the market. Should they be a little bit more proactive and say, hey, housing's starting to get really out of control. Maybe we should do a quick 25 basis points here to slow things moving forward. It's like they kind of wait. They just wait. They waited for so long. And I think they're behind the curve. And now they're tightening. In my opinion, they're going to be tightening into a slowdown.
I agree with you. Obviously, they're behind the curve. One thing I forgot to mention in my comments earlier, which is real interest rates are still minus like 3.5%. So even 25 basis points today is still, frankly, it's a drop in the bucket. Yeah. But I would say, just to be the one mini counterpoint is like, the front end of the yield curve. So the 2-year bond yield has done a lot of the heavy lifting for the central banks. So, it's not the central bank's job is to regulate banks. Obviously, it's also to message and do some kind of forward guidance. But I also think it's the signaling, which we got 6 months ago, you could argue kind of worked. Right? Because they said, okay, we're going to raise rate. I mean, I can't remember when they said it over the summer. They said, Q1 of next year, we're going to raise rates, whatever. It doesn't matter. My point is that precipitated, I mean, the US did it also, so it's not just Canada, but that precipitated the rise in the short-term bond yield, which in effect is a kind of rate hike from the central bank. Do you get what I mean?
Well, yeah, no, 100%. I think like it is all like forward guidance, right? So it's basically forward
it's
guidance
tied together.
Forward guidance again for those that might not understand that. It's basically just like them alluding to something. It's them forecasting. Basically, they're trying to change your behavior, your habits. And so you'll remember precisely at the start of the pandemic, Tiff Macklem came out and was like very adamant. We're going to leave rates at zero for a very long time into 2023. And that was like the green light. I remember saying that's the green light to speculate in housing. So everyone's like, oh my God, mortgage rates are 1.3%. This guy's going to leave them there for the next 3 years. Let's go load up. That's what they did. Now you're seeing, like, I see it with clients all the time. Hey, rates are going up, aren't they? Well, maybe we should wait. Maybe the housing market's going to start to slow down. So it's like just them like talking about rate hikes starts to change consumer behavior or market sentiment.
Can I ask one more question? Sorry, on the housing, I'm just really curious. So I know you said that sort of the volumes and transactions are slowing down, and sort of the froth is maybe it's coming off the boil a bit. Are you seeing more inventory? So, or are people, there was like, oh, we're not going to sell because of COVID. We don't know, blah, blah, blah. But are you seeing that? Are you seeing the inventory numbers change or not at all?
Not really, slightly,
Okay.
but like what I will say is, what I will preface is that we're actually entering into the busiest time of the year for the housing market in terms of March, April, May.
Housing very seasonal.
Very seasonal. So March, April, May, every single year, March, April, May, that's where you get the most number of new listings. Everybody lists their house for sale March, April, May. I don't know why. It's just what it is. So my thought process is like, okay, the housing market is clearly starting to slow down. We're now going to be entering a period where seasonally we got a lot of new listing activity. Is the buyer demand going to be there to meet that listing inventory? And my suspicion is yes, it will still be probably a balance to seller's market here in the spring. But I mean, it's definitely changing from all-time frothiness. The only other thing I'll just touch on here and get Keith, maybe your comments to summarize on this. But so people were asking about, we talked about this on the show before, but so keep in mind, right? So the Bank of Canada raised variable rates, they raised the overnight rate by 25 basis points. Obviously that changes the bank's prime rate, which is tied into your variable rate mortgage. And so just for everybody's context, because everybody goes, oh my gosh, there's going to be this huge calamity. So your variable rate mortgage yesterday went up 25 basis points. That equates to, so every $100,000 that someone has borrowed on a mortgage, that equates to roughly $12 increase on a monthly basis. So your payment went up by $12 to $13 per month based on how much you borrowed. And then just to quantify that one more time is not only about half of variable rate mortgages actually have floating payments. So half of variable rate mortgages have fixed payment structure. So even if the Bank of Canada raises 100 basis points, your mortgage payment will stay the same. The only thing that will change is how much of your payment goes towards your principal pay down. So people just think, oh, Bank of Canada raises its rate 6 times this year. That's going to equate to, the average mortgage going up $300-$400 a month. Nobody can afford it. Everything's going to blow up. No, keep in mind, a lot of the big banks, their product has a fixed variable rate payment, which takes a lot of that risk out of that market. So that's something I'd sort of preface. Keith, I don't know if you have any commentary on any of that, but.
No, but you did ask me just a few minutes ago about what are the rate expectations coming up. So the next meeting is on April 13th, and the percentage of a rate hike is 188%. Right. So basically what that means is that a 50 basis, so the probability, there's a high probability that the Bank of Canada will increase rates by 0.5% at the next meeting.
Half. So 50 basis points.
Well, it's not 100% guaranteed, but the market is leaning towards that right away. So 25 basis points is in the bag. If they don't do that, it's, they're going to shock the world again. But the market right now, they're saying, you know what, that there is a chance that they do 50 basis points as well. So, maybe where is it?
Who wants?
Yeah.
Oh,
the Twinkie box is coming up here.
Okay. Do we have a Twinkie bet here? Does anybody have 50 basis points in April? I'm going with no.
I'm going with
yeah. I mean, now I do like
Jesus.
Twinkies, mind you. So
This show is as boring as Tiff Macklem. Holy smokes!
No, I think we're pretty cool guys, actually. So we're not boring.
Are we gonna go?
So
are we going?
Yeah, let me
no,
just
no,
go
no,
through.
no. Are we going around the horn? Are we going around the horn here? I'll go 25 basis points in April.
Oh, me?
Yeah.
Oh no, I don't think they'll raise rates. No, I think they'll do 4 times this year. So this is the first, and then because I think the reason I think, and it actually is a good segue. Keith, you're up next, but this is a good segue because I think the Russia thing is going to get worse before it gets better, and then they're going to get scared off their path. So I'll take the under. I'll take the 0 for next meeting.
Oh man, Rich is going to start eating my Twinkies. I love Twinkies.
So much confidence in the old boomer, eh? So much confidence.
I know. But you made a good point, though. So if there was none of this, this crisis and war taking place, again, 25 basis points are in the bag. That's going to happen. And I do think they would love to do 50. I don't know if they would. I would actually put money on 25 basis points. But it comes back to your comment, Rich. Like if you feel that, the situation over in Ukraine and elsewhere, it could spread. If it's going to get worse, then, that absolutely puts a 0 rate hike in play. So my suggestion to you, Rich, is don't get excited about the Twinkie. You need to look at the Canadian Bankers Acceptance Contract, my friend. You can buy a nice, you can, make enough to buy like 5 condos from the king of Kitsilano. You can do this.
I want a condo in Banff or somewhere near Calgary. That's where I want.
Hey, come on down. But
let's put some more numbers here, guys, just to let you know. So by September, right now the market is saying we should be at 1.5%.
Keith,
so
it's not happening. It's not happening.
That's embarrassing. But anyways, Keith, can I ask you, because I think the viewers might want to know as well, and I think there's a couple distinctions when we talk about like market pricing in rate hikes. Isn't there there's multiple ways to price
different products? There's different products.
So can you explain like which one you're looking at and maybe the difference?
Well, for these numbers here, I'm just basically looking at what the estimates are. So the economists who contribute to Bloomberg for the Canadian marketplace, and there's a bunch of them. It has their estimates coming up over this cycle. So these will be all the key economists with the big Canadian banks, as well as the global banks that follow Canada as well as some of the independent shops like Global Economics and those guys. Like they're in there as well. And those guys are pretty good at this part of their job on the economy. The whole job numbers and inflation data points, they're a bit trickier to get done. In terms of trying to play this as an investor, it's difficult for the retail investor to do it. It's easier for a professional to do it if they have access to some of these markets. And to do that, you had to be able to trade futures markets effectively. And again, not all investment professionals have access to that market. However, there will be a lot of money playing this right now. So like a lot of big hedge funds out there, and even pension funds trying to hedge their positions, and banks as well. Banks are using these markets all the time. So the tools are available, but for the average person thinking about their RSP and stuff like that, as Rich pointed out, a lot of this has already been priced into the market. So I'm happy to chat with
Steve.
But I'm happy to chat with any. But I'm happy to chat with anyone, like specifically on things. But you can do it, but you need to know what you're doing, basically.
Well, no, okay. I mean, anyways,
let me answer. So to answer the question, because Keith skated around it, I'm just going to nail it down. there's the banker's acceptance, which we've talked about a lot. There's something called a forward overnight index swap. Again, you only have access to these kinds of things if you're on a trading desk. And then the other way to simply do it is, if you really were keen on it, is you could literally be buying or selling the short-term bonds. So the 3-month out, 2-year out, whatever it is. And in the US, to give you context, is a Fed fund futures, which is basically a bond-like instrument that pulls to par. So that basically, as you get closer and closer to maturity, it goes to 100, and you can basically buy or sell that. But almost all, as Keith outlined, almost all these products are basically only available if you're on a proper trading desk. I think retailer investors should probably stay very, very far away from making these kinds of bets. Anyway, back to you.
So the biggest, just to touch on that, but the biggest market in the world for this is the euro dollar contract. So that's linked to the Fed funds futures, what Rich just mentioned, and that market is enormous. It's if you look at the trading involvement today, it's just flying through, right? It's a really great market. The Canadian equivalent is the Canadian Bankers Acceptance Contract, which is a play on the Canadian Central Bank rate, but there's a bit of a credit spread attached to it as well, because that got a bit funky back in when the pandemic, was kicking in 2020. So that was the long answer, from. Maybe I made it too long, but
yeah,
there are opportunities, but don't the average investor, listening think, yeah, I'm going to run out and short the Bank of Canada, because you sort of got to know what you're doing. And most, if you go to your mutual fund guy, he's not going to have a clue what you're talking about.
So long story short is, it's safer for everybody here that's listening just to bet. If you're going to wager a Twinkie. And, keep it simple. And by the way, I think Keith has the only box of Twinkies in all of Halifax. So, geez, your house is going to get targeted here. But yeah, I think that brings us to the next point, Rich, which is tying this all in here, as Macklem talked about today, boring Macklem, is commodity inflation. We've got, oil, even in Western Canadian Select here, is over $100 a barrel, playing into more inflation, right? As we've talked about before, oil is life. It's basically in every aspect of our lives today. So that higher input cost is going to trickle through. So, and then we've got, Ukraine and Russia, which are huge, wheat and grain suppliers. What are they? I don't know what Ukraine is. Was it 30-40% of wheat supply? I don't know. Rich, you'll know better. I'll turn this to you. But how do you see this sort of playing out in markets and in general? Right? The biggest thing I'm looking at is like, oh my gosh, like if you think food inflation's been bad over the last 12, 18 months, I'm like, this could get really nasty. And yes. I think that's when you get that social unrest, right? I mean, like, hey, it's all fine and dandy, a little bit of inflation here, but when people start saying, hey, I can't put food on my table, I think that's when people get really upset.
Yeah, so I think what's important so one of the things I object to is central bankers using what's going on in Ukraine and relating that to inflation that we're seeing. Because remember, what is inflation? Inflation is some kind of price index, whether it's a producer price index or a consumer price index, and it's the change. So the year-on-year change, or 3 month on 3 month, or whatever it is, but it's the change over a time frame that's in the past. Yeah. So the fact that oil's gone up $10 or 10% over the last 2 weeks or whatever, it does not. I mean, that's the idea that they would blame current inflation on what's happened in the last 2 weeks. That's just bogus. So let's just keep it. I think it's important that we understand sort of the definitions of what we're talking about. As far as commodity prices, I think what's really fascinating is before this kicked off in Ukraine, before the invasion of Ukraine, non-energy commodity prices. So what is that? That's everything from gold to pork bellies to cattle and milk and everything in between. That had already reached sort of the all-time high. And the all-time high, according to the Goldman Sachs Standard & Poor's Commodities Index, was April 2011. If you look at grain, so there's different ways. Obviously, that's made up of a bunch of different indices for commodities. Obviously, I excluded energy because energy is just sort of its own market. and it's its own sort of animal. But what is non-energy commodity prices? That includes agriculture, industrial metals, precious metals, ferrous metals. It also includes, we mentioned agriculture, but important in that agriculture index is obviously grain. And that's where things like wheat obviously really matter. And your point about social unrest, if you'll recall that April 2011, it's sort of not an accident, or maybe it is a coincidence, but that the, what was it called? The Arab Spring happened in and around the summer of 2011. And, who can blame them, right? I mean, these countries, so the poorer you are in general, the more and more you spend on food relative to your overall relative to your disposable income, the more and more you spend on food. And grain, in some way, shape, or form, is the most important food stuff in the world for everybody, whether you're Chinese, whether you're African, whether you're Canadian, whether it doesn't matter. You're spending the vast majority is either grain or a derivative of grain. So if you're buying beef, lots of animals will eat corn, or, not everybody is rich like Steve. They can eat grass-fed Kobe beef, but for the rest of us, we're eating USDA meat, and it's almost all of that is corn-fed. And so that's why people are, and then we didn't even talk about the fertilizer point, which is also used in growing, obviously, all of these foodstuffs. And so, if I'm looking at the grain index right now, which and we're back to basically just a sniff below all-time highs again, 2011. And I think the really important thing I think we're all sort of forgetting is, and why I think it's going to continue to ratchet higher, is two reasons. One is inventories were already quite low for various different reasons. There was a really bad harvest in Brazil, I believe. I think a lot of key, storage facility. There was a storage facility you mentioned.
Sorry, just quickly chime in here. Nation. So in Canada, 40% of Western Canada's grain output was basically wiped out due to dry conditions, essentially, last year. So basically it says here stockpiles of wheat in Canada dwindled to 15.6 million tons at the end of December, down 38% from a year earlier.
Yeah. So it relates to the oil sector in a sense, because, you had, and obviously the shutdowns and the lockdowns, they affected it. There was shit weather over the last little while. It's sort of just like, it's like a perfect storm. But I also think what's also really important, especially this is true for the basic materials sector. I don't know if any of you guys have noticed, but lithium prices are through the absolute roof. Partly this is because of the lockdowns, but it's also partly because, and I mentioned this in my oil rant from a couple of weeks ago, it's a function of the CapEx spending. So what's CapEx? CapEx is capital expenditure for mining and metals companies. And that's relative to sales, relative to assets, relative to any way you want to sort of measure it over time. The CapEx spent on resource extraction is basically at 20-year lows. And why is this true? Because of a lot of green energy policies. I'll skip that rant for now. But the point is regardless of why it's happened, it is happened. So you got short-term inventories are low. The long-term, medium-term prospect for improving those inventories are also low. And then obviously demand is coming back online. And so you've just sort of got this sort of perfect storm. And I think that absolutely think commodities are going to, and then obviously you've got the Russia-China thing. Russia is a huge producer of commodities, especially for the West. So I think we're over the next little while, I think we're definitely going to see some higher commodity prices. I don't know if it'll be sustained. I mean, humans know how to grow and accumulate grain. So
just to quickly touch on this before I get to Keith's comments here, but CP Rail here in Canada is actually potentially voting to go on strike as of March 16th, which could further disrupt deliveries of key fertilizer for farmers, just as they're trying to sort of play catch up here. Canada, along with Russia and Belarus, are one of the main sources for the world's potash, which is commonly used in fertilizer. So, turning into a bit of a shit show. Like I said, I think if you want to get, you might want to get long some food, get long a Costco membership, because I think it's going to get more expensive to put food on the table here moving forward. Keith, any sort of comments and maybe how you see this shaping up into financial markets as well? Like, obviously we see the dollar wrecking ball is certainly part of your bull thesis, and that seems to be playing out as well.
Again, I think, from a financial market perspective and the economic perspective, this is just incredibly fascinating. So I've gone through a number of these over the years. But first of all, back to Rich's point with food and specifically wheat. So, we have exposure directly to agricultural commodities. So the three main ones are wheat, corn, and soy. Those are the three main ones. But to give you an idea, like over the last year prior to the Ukraine-Russia war, the price of wheat went from roughly $650 up to $800. So what's that, like a 20% increase, I guess, something like that? And that is reflecting tighter supplies, less yield on the crops that are out there, fertilizer was becoming more expensive, all that. And then all of a sudden, the war started. So now the current contract for wheat down in Chicago, it's gone from $800 up to $1,200. So that's a 50%, that's a 100% increase in wheat over the last couple of weeks. And so what we like to look at from an investment perspective is whenever I see any market go vertical, up or down, that's exciting. That's exciting because the world is not linear. Nothing ever stays in the current trend forever. Something will turn here. If this war, if there's a resolution to it at some point soon, and I think there will be, because alternatively it means it gets really bad, and then we're moved to a completely different phase of it. And the way mainstream media is right now, that's what they're telling everyone. Like there's never a horizon, right? It's a dark tunnel and that's it. And I don't think that's the case. There will be a resolution of some sort coming up here. So in that space, you would, as soon as the war is over, or there's a resolution and everyone, wins a little bit from it, because that's the way they have to do it. For example, Russia cannot lose this and not save any face in anything. Like it just doesn't work that way at that stage. The Russians have to get some kind of consolation prize. So people that think, Putin's going to get dragged through the streets and all that, if it happens, it's going to create even a bigger vacuum in the world of what happens next. Because right now we have one world power, that's it. People think China and the Russians are combined or close to, but it's not. But you don't want one extreme power in the world, and that's what it is right now. So we have that taking place. But let's jump over right now to what I find the most fascinating, because I like to talk about the financial world is changing, and it's changing rapidly. And I've been saying this for a while now, and now we're actually seeing it, because when they let a certain genie out of the bottle, they can't put it back in. So first of all, we've always known in my world that the biggest weapons that the Americans have, it's the financial weapons. It's not the Navy and all that stuff, which is incredibly powerful, by the way. Nothing can top the American Navy. However, what happened when they first started putting sanctions on the Russians a couple of weeks ago? Remember Biden said, no, we're not going to cut them off swift. We're not going to do that, because he knew, or his advisors said, no, we can't do that. That's really going to change the world dramatically. And then something happened overnight. All of a sudden, I think it was Germany, the Italians, and I forget the other country. Did they finally accept it? Yeah, we'll do it. So with the Russians now, these are the list of things that we talked about last week, and they are happening. So the Russians, we have the sanctions taking place. Putin is now on the sanction list. He wasn't before. The Russians, a lot of their banks have been cut off from the SWIFT dollar system or network. By the way, they can still trade oil on it, apparently. Central bank assets have been frozen by the Central Bank of Russia. Russian equities have been removed from all MSCI indices. And that might sound boring, but for all these ETFs you buy from emerging markets, any kind of investment held in Russia, that's now sold. It just has to go out by law. It's an incredibly powerful tool, because when that's in place, and this is one way the Chinese get a lot of capital, by the way. So their companies are included in the MSCI index because they lobbied for that when they entered the WTO back like 20 years ago, whatever it was. All of a sudden then, like every day, like there's tens of millions of dollars in capital investment flowing into China. Anyway, the Russians just got shut out of that. So now all of a sudden, credit ratings on any kind of Russian-related debt, they've been downgraded or with no rating. That means that pension funds are no longer allowed to hold this stuff. Russians can no longer do any equity or debt sales in the U.S. And even the Swiss banks have frozen assets from certain Russian individuals. And for the Swiss to do that, again, it's pretty big. So, I know I just droned on and on, but.
Wait, can I just chime in really quickly here?
Yeah.
I forgot the most important one. Roman Abramovich had to sell Chelsea Football Club.
I didn't see that. Yeah. For everyone else, we're gamers, right? Hey, yeah, wow, that's crazy, but that's an enormous asset. I don't know who's going to buy it, but we'll
the Saudis.
See. Well, I mean, the Saudis are up in arms today, right? Because of the Iranians might have their the sanctions lifted against them. So everything here is connected, and even if there's a resolution this afternoon to the war, it's highly unlikely all these sanctions are going to be lifted. The Russians will be turned back on to SWIFT and all that stuff. And again, this is the financial weapon. So I've said numerous times now in writings, interviews, and all this stuff. The most powerful, if the Americans want to turn off the Chinese economy, they can do it within 10 days. They just cut them out of the SWIFT dollar system, specifically Hong Kong and specifically HSBC, because that's where they get their dollars all flowing through HSBC. And this is now confirmation to the world that, hey, now they can do it because it's happened with the Russians. It's not as severe economically for the world with it happening to Russia. If it happened with the Chinese, then yeah, it's an insane moment coming up. But now that's hanging out there. That's out there now in the world, and the Chinese are aware of it. And anyone else, so the Americans say, hey, if you're not on our team, it means you're on the other team. And, we can cut you off financially. So again, I'm just going to stress, this is an enormous week for this, and it's not going to change coming up.
Can I just ask a question, Keith? I mean, does this accelerate China's desire to pull away from the U.S. with respect to all these funding markets, whether it's dollar trades, whether it's the petrodollar, you know what I mean? People have talked about the petro yuan in the past. Do you think that's bogus, or do you think that accelerates all of these trends to kind of de-link and disconnect the Chinese financial and sort of trade credit markets to the U.S. and Europe?
You mean the petro ruble yuan?
You're gonna have to think of a better name for it.
Don't start.
No, but honestly, I know we're joking, but if you're Xi Jinping, you've almost certainly been startled by the speed and the effectiveness of this, frankly, act of war. And I was just wondering if you thought that the Chinese will take pause, or will they accelerate their plans, or is it all BS? And
so I love that question. Like Steve's question earlier wasn't very good, but you just answer it anyway. But this is a much better question. So one thing I didn't mention though with Russia, there are bank runs now. People are scrambling to get US
lines
dollars.
at the ATMs. There's lines at the ATMs.
Yeah, like
and then Bitcoin jumped. People
going
argued
into crypto. You hear that, Keith?
Yeah, like crypto, it was jumping up. But everyone, like even today, for example, and you got to take everything with half a grain of salt as well. But there are rumors in Russia tonight that they're going to impose martial law, and any male 18 or over, they have to stay in the country, and then they can be conscripted into the army. So
because people are leaving. There's flights out of Turkish Airlines has seen huge amounts of flights out of Russia.
Yeah. So again, life has changed dramatically, and that's not going to get reversed. However, this is resolved. Financial markets will reverse aggressively. I'm a true believer in that. But back to the other question about the Chinese. So first of all, no one likes the current system. It's a system that just evolved. And the reason it evolved was because when World War II was over, and during that time, everyone in the world, they all moved their assets to America because America, even though they were heavily involved in the war, there's not one shot was fired in the U.S., right? The U.S. it's physically imposing. No one can attack it and all that. And that's why all the wealth has stayed there. All the loans after World War II to get things going, they all went through the U.S. American institutions and all that. So here we are now, like years later, and it's grown into this behemoth where there's no alternative, Rich. So they want an alternative, and everyone's wanted one for a long time, but no one's been able to create one. So this does, accelerate the desire to have one, because the Chinese are absolutely sitting there saying, holy smokes, if they turn off the SWIFT system, or you guys don't even know this, okay? So HSBC, for example, they were caught laundering money for one of the largest Mexican drug cartels. And so this was back in the 2014 or 16, agreeing, whatever they went through in the end.
It showed up in Kitsilano.
There's a great Netflix special, by the way, called Dirty Money, and they explain the whole thing. Is fascinating. It's wild how no one went to prison. Anyway,
it's incredible. Yeah, absolutely. So like if you or Steve laundered money for any kind of drug cartel, you're in prison. That's where you go. If you're running a banking institution, you lose your license.
You get promoted.
Yeah, but jokes aside, but HSBC, they paid a fine, and then they establish all of these other red lines. And if you cross any of the red lines, you are now going to have criminal prosecutions and you're going to lose your American banking license. They've already crossed a lot of these red lines, and the American institutions have still not acted upon that. They have the legal right to do it. The Trump administration, they went close several times to doing it. Every time they're about to do it, they were told by Treasury, don't do it, because it instantly causes a collapse in Hong Kong, which then drains everything out of China as well. And so for those that don't know, so Hong Kong, for example, HSBC, their business is basically split between, the Chinese business and then outside of China. And they're in a really hard place there a couple of years ago, because they were told, the Western world said, hey, if you do any business with the Chinese, your guys are going to go to jail, you're going to lose your license. And the Chinese told them, hey, if you do this, you're going to lose your access to Chinese and Hong Kong markets. So these poor guys are sitting there saying, what do you do? Like two extremely powerful groups on each side of you. So what the HSBC did, they've actually sided with the Chinese. So they'll continue to do everything that they've done before. But the threat is there now. So, and the Chinese are aware of that. And because the Americans have turned off the Russians from the access to capital markets, they're able to do that now without having any remorse. They're saying, wow, we did it to the Russians. And again, that's not impacting the financial world. If they do it to the Chinese, it's going to hurt everyone. Like, we're all going to feel this one.
But Keith, isn't this something you can only really do once? Like, does that make sense? I mean, I know you could probably do it to Hungary or, Australia, or frankly, other countries that don't frankly really matter. Canada, if the US wanted to kick Canada off SWIFT, I mean, some rough, maybe, Justin Trudeau would do something, I don't know, eat a donut or something, who knows? But my point is, this is sort of something you can only really do once, isn't it? I mean, yeah. So they fired their shot.
So if you do it once, I mean, you can't turn it back on, right? So that's why it's a very heavy-handed response by the Americans if they do it. And again, this has been known for a while. The State Department are aware, with Treasury Department, the Fed, the CIA.
But that's sorry to interrupt you, but isn't that the point why, in a way, it was sort of, I mean, isn't it more useful to hold it as a deterrent? Do you know what I mean? To extract concessions before you execute on this plan, rather than to just, because like now, not to get into geopolitics, but like now Russia's kicked out. So what the hell do they care, right? Do they, now they're just going to push through with what they wanted to do anyways, if that makes sense.
Well, again, I think the Russian situation is something happened we won't find out about months, years down the road. Something happened very abruptly behind the scenes because the Americans said, no, we are not going to sanction Putin and we're not going to cut the Russians off the SWIFT system. And again, I think oil is still trading. So you don't have to, that capital is still moving, but the Russians are struggling to get something set up because again, they've lost access to capital markets. That's the big thing. And to answer your question, I mean, with regards to China, it's been dangling there for a while. I mean, like there's no secrets. I mean, if the Loonie Hour is talking about it, I mean, we're smart guys and everything, but no offense, guys. I mean,
how dare you?
How dare you? Yeah, everyone else is aware of it as well. It's there, but everything. The reason they're dangling over the Chinese, whether it's for what happened with genocide over there, or taking freedoms away from Hong Kong, intellectual property theft. I mean, you can go on and on and on, and like they haven't stopped, right? So, but again, we'll just see where it goes. So if it does happen, the effect on Canadians is financial markets will get thumped, but the dollar would just scream higher.
U.S. dollar, you mean?
U.S. dollar tightening, ultimately, tightening of general market liquidity conditions.
So if this weekend, if they turned off SWIFT from the Chinese for whatever reason, and again, everyone, this is not happening this weekend, so don't run out and say the Loonie Hour said this is going to happen. But the main dollar index, the DXY index, is about 98 right now this morning. On Monday morning, that thing would open up at around 125, 150. Like it won't even be priced. Yeah. So the other thing, like we talked, for example, like energy is screaming higher now. Like what's the worst performing market, the currency market right now, besides ruble, of course, it's euro. So euro is underperforming the Turkish lira right now, right? So again, like we know Europe is screwed, but if energy screams higher and they're getting cut off from getting Russian energy and all that stuff. Again, everything is connected here.
I think we should thank all the green.
Sorry, yeah.
Don't go. No, go.
I was gonna say, hasn't the Canadian dollar been relatively underperforming right now as well, which is somewhat eye opening, all things considered, because considering our commodity based nation here. Yeah,
Canadian dollar's done quite well, actually, guys, because it's getting a bit of support here with oil, going higher.
Don't you think it should be arguably?
It's definitely disconnected. There's been a decoupling in the dollar, but no, you're right to point that out. I mean, over the last couple of days, I haven't really paid attention to it, but over the last 6 months, as the dollar has ratcheted higher and higher, and the U.S. interest rate expectations have gone into the stratosphere. I mean, you've definitely seen the dollar starting to lag the price of crude oil. And I mean, there are different arguments for why this is happening. I think it's largely a function of the fact that Canadians will not be able to raise interest rates anywhere near as much as the US, for a bunch of reasons we've covered on this podcast before. But yeah, you're right, Steve, just to point out that there's definitely been it's disconnected from oil in a little bit.
That's where we end it, right there on the Canadian dollar. Just to summarize, we do have a bet on the table for April. Rich is going with no rate hikes from the Bank of Canada. Keith and I are in the camp of 25 basis points. So there's another Twinkie on the line. And as always, we appreciate the support. All we ask is that you share this podcast with at least one friend, one family member. Let's continue to grow the Loonie Hour community. We appreciate your support. And as always, we'll see you every Friday. Thanks for tuning in.